everyone to the first webinar at Real Estate Intelligence. Many of you know me as on Analytics. I'm the founder of Analytics Miami for the past 7 or 8 years. I've been publishing long-term trend analysis in the markets. So this is a new platform here that we just launched. And this is John, who's one of my partners on this platform. And this platform is intended to be an education tool. It kind of systematizes the work that I've been putting out and puts it in a regular weekly format that's designed as an education platform to help real estate professionals and people operating in the real estate space understand what's happening in our market and then communicate it to their clients and their associates. Because we're in a period of time right now where our market is increasingly differentiating itself from the national narrative in other parts of the country, and we have unique forces at play in our market. So it's important that we either as real estate professionals or just actors, players in the space, know this, understand this, we can position ourselves effectively, and so that we can communicate this message to our clients. That's really the purpose of this platform. And this is the first webinar. So we're at the end of Q2. We're halfway through the year. On this first webinar, I'm going to start with a macro dive. They all will. So one thing I've always said is that the macro drives the micro, right? Nothing happens in isolation. Data points are they're just spots in time. If I tell you something is true, what does that matter? You don't know where it was yesterday, you don't know where it's trending. The macro drives the micro. So the way we present content in the platform and this webinar is that we start with macro overviews. We identify macro forces that are driving what's happening here. And then from there, we delve into more micro deep digs into segments of the market. So on this first webinar, to set the stage, all of this, because again, part of our whole thesis is that we're in the early stages of a major shift in focus and a shift in the world, and that Miami is emerging as one of these new 20th, 21st century capitals. We're going to start very macro. We're going to start very macro and identify the principles, the real forces that are driving what we're seeing around us. And then we're going to dig into some Q2 numbers, and more of the Q2 numbers will be available in the Q2 report, which will be out, but this will dig into some of those as well. And then we're going to touch upon some other recent news items that corroborate our thesis, which is exciting when your thesis is corroborated, right? This is actually borrowing from a talk that I gave last month at the FIAPSI International Real Estate Congress. That was a great talk. People came from over 35 or 40 countries. They paid $2,000 a ticket to hear this speech. So you guys are getting in on the webinar. And the topic of the speech was predicting the future, follow the money. And that sets the stage to help us identify the forces that are differentiating our market here in South Florida. So we're going to start with that. I'm going to screen share right now, and you should be able to still see me at the top of the page, I believe. Let's see, share, and you guys see predicting the future, follow the money? Yes. Yep. All right, great. So this was the topic they gave me at this conference, and again, it was intended to set the stage for what's happening in Miami. And I made the joke, I said, well, that's quite the tall order. I don't have a crystal ball, so how am I supposed to predict the future? How can any of us predict the future, right? So I put forth, oh wait, how do I advance slides here? I put forth this initial question. It's a quote from Einstein, that if I had an hour to solve a problem and my life depended on the solution, I would spend the first 55 minutes determining the proper question to ask. And once I know the proper question, I could solve the problem in less than 5 minutes. And again, this takes us back to that principle of identifying the driving forces of what's happening. So the question that I asked is, what forces are driving Miami's outlier performance? Are they sustainable? Because we have seen that we do indeed have outlier performance. The chart on this page was published by Knight Frank, and it shows that Miami is the fastest has had the fastest growth of any prime real estate market globally. I'm sorry, it was second, only to Dubai. So that's quite the outlier data point. This was very much not the reality pre-COVID. This is the reality post-COVID. And what we've seen happen here, what's driving it, and is it sustainable? That's the question to ask. So I got a little bit esoteric here because I wanted to identify the inevitability of change. This is a very important thing to explain to yourselves and to your clients. There's this fallacy in human nature to believe that the present is sacrosanct, that how things are is how things always will be. People say, oh, things will go back to normal. They will do this, they'll go back. Things never go back to normal. They always shift. New York was the capital of the 20th century world. Before that, it was London. Before that, it was Amsterdam. Those cities didn't blow up and die. It's nothing that dramatic. There's simply a shift in focus. These shifts are precipitated by technology, but what do you want to call it? Basically, it's human behavior. And the change is inevitable. Look, we have cell phones here. This was magic 50 years ago, and now it's ubiquitous. We run our lives on them, right? So the next 50 years, I would put forth, the change will be even faster because of the communications that we have, technology, all immediacy of communication, I could say. So I put forth that, history equals change, as we all know, and that really is just the aggregate of human herding behavior. Humans herd, they follow each other like this. They push the condition one way in one place, it goes too far, they go into another place. And I am within all of this and very optimistic. The national news, all news is negative because they like to clickbait all that stuff. But human prosperity always finds a place to flow. Our standard of living keeps going up. You just want to make sure that you align yourself to where that prosperity is flowing. It always goes somewhere. And that's why I have that chart there showing per capita GDP across the globe. I don't think any of us want to live 500 years ago, right? As long as you avoid calamities and position yourself to where the flow is going, there we are. Like I joked, the 20th century was awesome, unless you happen to be in Hiroshima when the nuclear bomb was dropped, right? So avoid the calamities, follow the flow of money and position yourself accordingly because it's always going somewhere. Next, why do certain periods in time experience accelerations and change, right? Change does not happen at the same pace all the time. There are periods where it happens much more quickly than others. The most recent period prior to our own, we could say was actually the period post-World War II. And many of the modalities of life that we consider to be normal pre-COVID, pre-internet, were 20th century, post-World War II, pre-internet realities. Think about how we live, how we work, office centers, all these things. They're all established in the 20th century. So why now are we having another period of rapid change? Well, really, there are three forces that can accelerate change. One is I'll call empire cycles. All empires have them. Nothing is forever. That's a more complex conversation, but it is what it is. The next one is tech adoptions. Think of what the Gutenberg printing press did for Europe, for example, what the airplane did, the telephone did. And now, of course, we have the internet. The internet came at the end of the 20th century, and it was incorporated piecemeal into existing habits. We never stopped habits to recreate life around the internet. We took work the way it was and brought it in slowly as a tool. And then, of course, there's wars and pandemics and what they do on the restrictions of people, their movements, what they do to sovereign debt, all that stuff. So actually what we have right now, we have the confluence of all of this. We are right now in the middle of the Venn diagram. We're at a certain interesting point of the US empire cycle where we have polarizations of wealth gap, belief systems. We know this from national elections, all that stuff. We have tech adoption, we have how people live and work reshaping around the internet, and we have a war pandemic that accelerated all that because it broke habits. So right now we're in this unique position of really being in the center of this Venn diagram. And I believe that this change, this acceleration is going to play out over the next 5 to 10 years. So again, think of COVID as a grand accelerator of trends away from pre-internet 20th century epicenters. All those capitals, all those ways of life, they were all established before the internet, and now we're emerging into a new reality. And so what does all this mean for South Florida and Miami real estate? That is the question. Well, what we've seen is a tsunami of cash, record sales at high price points, and a rapid shrinking of inventory. So let's take a look and see what that looks like. This is updated through Q2, through June of 2023. I made these first update charts for tri-counties. This is an aggregate of Palm Beach County, Broward County, and Miami-Dade County data. I would like to emphasize that the patterns hold for all the counties. The counties are shades of gray. Some are experiencing, 10, 20% bigger dips or spikes, but the patterns are exactly the same. There's some variance in product type, neighborhoods, all of that, but South Florida is, as a whole, is experiencing this flow of wealth and talent, and it's just playing out slightly different across the counties. So what are we saying? We're saying that through Q2, tri-county, both single-family homes and condos hit a record high price. They're up 4% year over year. And most notably, they're up single-family 72% versus the pre-COVID 2019 reality. In condos, 48% versus the pre-COVID reality. And again, I'm going to emphasize it's very, very important to think of our market in pre and post-COVID modalities, because those are very, very different realities that we see playing out. Next, the news loves to report on sales volume and sales volume dropping, right? They love this across the country, here, everywhere. If you're reporting sales volume by itself across the whole market, across all price points, you're missing a few things. You're missing outperformance of certain price points that are there on the receiving end of the wealth and talent migration that have not spiked down. And you're also missing the reality of inventory. There's a relationship between supply and demand when we think about sales volume and inventory. So for example, we have tri-county here, single family homes. This again is data through Q2 2023. And we have a sales volume down 27% versus Q2 of last year, and down 69% versus Q2 of 2019 pre-COVID. Okay, fine, but at the same time, we have inventory down 52% and 12% year over year. So when we dig deeper into this, actually, you'll see that the massive drops in volume are due to the massive drops at lower price points, which have basically gone away. Below 500,000 for single family homes has basically disappeared, and at a much higher rate than sales volume has disappeared. So actually, our supply and demand metrics are far healthier than drops in volume would lead you to believe, as reported by the general media. If we look at the same pattern holds for condos, condos have held a little bit more steady. There's 27% down sales volume Q2 versus Q2 2022 and 11% versus 2019. But look at this, we're down in volume 11% versus Q2 2019, but the inventory is down 50%. So actually the supply demand fundamentals in the market are far, far stronger than they were pre-COVID. And this is across all price points in the market. Inventory is down 50%, but volume is only down 11% versus pre-COVID. So it's a very, very tight condo market. Next, this is where it gets interesting. This is the part that I want to show. So Tri-County single family homes below $500,000. Inventory is down 83% versus pre-COVID. That is basically the evisceration of a price point. It's 83% drop. That means that there were 12,101 listings below $500,000 Tri-County in June of 2019. Today we have only 2019, an 83% drop. And this holds Tri-County. When we break it down on a county per city level, it's really shocking. When someone starts looking at single family homes, even below 600,000 within a certain area, we're talking 40 listings. There's nothing. And this is a whole price point disappearing. Why has this happened? Well, there's friction at this price point because of loans, obviously. People were locked in at lower mortgage rates. Now they have to get more expensive financing. And at the same time, median pricing has gone up 60%. They're getting less house for more money and paying more for that loan. So they're locked in. And at the same time, we have this influx of new people coming in. So that's what's going on there. Condos, very similar. Condos below 300,000, we're down 67% versus pre-COVID 2019. So again, that's also essentially the disappearance of a price point. The whole price floor has been pushed up, actually, is what this tells me. Okay, now I'm going to do a deep dive into single family homes, and we're going to look at Miami-Dade data for this. But again, the pattern holds throughout. I mentioned that floor has risen, that inventory below 500,000 has essentially disappeared. And we know that overall there was a transaction volume drop to varying degrees across the market. Here's one interesting insight that we have here. I have here in the chart a breakdown of price points. We started under 500,000, then 500 to $1 million, $1 to $2.5 million, and so forth. And if you look year over year, the healthiest price point in terms of fluctuations in sales volume is the $500,000 to $1 million mark. It's only down 5% year over year, while the rest of the market is down tremendously in terms of transaction volume. And versus pre-COVID, it's up 121%. And why is that? Partially, it's because that floor has risen. There's been a swap here. Pre-COVID, the majority, the plurality of transactions in single family were below 500,000. Now that's shifted. Now it's between 500,000 and $1 million. That's actually where that market segment has gone. So if we're looking at this in terms of anyone's an agent here, that's where the volume is now. It used to be between 250 and 500. Now it's between 500 and $1 million. And again, that segment has been most stable year over year. If we look further in this chart, we can see in the far right column, I have performances of each segment compared to what they were pre-COVID. And as you can see, the higher up you go in price, the more that segment is outperforming pre-COVID realities. And that's a very, very important thing to look at. We're going to touch upon this concept throughout this presentation, is that the high end, the higher you go in price, the more that segment is outperforming pre-COVID realities, because the higher up you go in price, be it total price, like I have in this chart, or price per square foot, the more that segment is attracting the domestic incoming wealth and talent migration, which is very, very real, and it's outperforming pre-COVID realities, and it's not going back. Next, we're going to dig in here. Miami-Dade, below $500,000, single family homes. Look at this. This is what I was saying. Available active listings down 86% versus pre-COVID. Pre-COVID, this time there were 3,782 listings. Now there are only 513. And actually, if we look at various neighborhoods, for example, off the top of my head, I know Coconut Grove below 2 million has basically ceased to exist. And that used to be the $1 million benchmark. So the floor is rising in all these markets. Sales volume is down 72% versus pre-COVID. But again, only sales volume is down less than inventory is down. There's just a squeeze. So when the press reports these numbers and says, oh, volume, let's say in this case has dropped 37% year over year, 72% versus pre-COVID. Well, it's because active listings are down 86%. How could volume not have dropped? There's no inventory in the market. Next, there's that segment that I was saying was the most robust, the $500 to $1 million segment. This segment actually, like I said, experienced the smallest drop year over year, and now accounts for the majority of single family. Now it's the segment that has the most transactions, but where before it was the sub 500,000. So this is where the consistent action is now in our market. And again, this reflects the rising of the single family floor market. Let's take a quick look at the $1 million to $2.5 million segment. And this again starts to show us how luxury is outperforming. So when we look at it versus pre-COVID, volume is up 106%. And if you remember the charts from the beginning of the presentation, if we carried this forth and started looking 5 million plus, 10 million plus, those multiples versus pre-COVID are going to be much higher. At the same time, inventory active listings are actually lower than they were pre-COVID. So it's a very tight market. So for the 1 to 2.5 segment, active listings are down 26% versus pre-COVID, while transaction volume has doubled. So those are very, very tight markets, and again, are reflecting the appetites of the incoming wealth and talent migration, which is very real. Okay, this is something that I kind of fascinates me. This is we look at sales volume by price per square foot, and I really like looking at this because it isolates for new construction, new expensive stuff per square foot. If something is big and old, it can still cost a lot, but it's not new and fancy. So this isolates for new and fancy because we're looking at price per square foot. This data is through April. When you download the report, it'll be through June, but it's the same exact pattern. So what's happening is the higher you go in price per square foot, we're outperforming COVID by magnitudes. Past $2,000 a square foot, we have 410% more transactions than pre-COVID, and 94% were all cash. So that to me is quite literally the creation of a whole new segment of the market, and they're paying heavy cash. If we look at sales of condos between 1 and 2,000 a square foot, there's 77% all cash and up almost 200% versus pre-COVID. So this to me tells me that the increase, the spike in market action is not just inexpensive, but new and expensive. The incoming wealth and talent migration wants fancy new product that's built to modern post-COVID standards and higher standards of interiors, construction, ceilings, all that stuff that you can't retrofit for and change in older buildings. And again, heavy cash, which presumably will be less affected by mortgage rates. The right chart shows our active listings. So above $1 million versus pre-COVID is down 29%. And below $1 million, right, 63%. So looking at that above $1 million, down 29% in the face of this spike of cash buying at the very high end. So that's really what's become the healthiest segment of our market. And again, because we're on the receiving end of this wealth and talent migration, I had a question that I will take in the end. Oh, that was you right there. Okay, cool. Next, now that we've talked about this and the two markets, let's take a look at cash. Oh, I'm sorry, this is single family home. Single family homes follow the same pattern. Past 2,000 a square foot, up 467% versus pre-COVID and 81% all cash. So that's kind of crazy to me. Actually, we had months, especially last year, where in 1 month, we would have sales past $2,000 a square foot in excess of what occurred in previous calendar years. So that, again, that's the flow of the wealth and talent migration. Single family homes built between 1 and 2,000 a square foot, 72% all cash. And again, the inventory drops there above $1 million. We're down 13% in active listings versus pre-COVID. And look at that. While listings are down at just $1 million, at the very high end, we're up 467% in sales volume. And again, remember, overall transaction volume has dropped from the earlier charts, which is also why it's important. When you look at charts that show you transaction volume for the market as a whole, it's very important to remember that the market is not a monolith, especially our market. The overall transaction volume drop is due mostly to the plummeting of volume of lower price points because there is no inventory. That's why it's important to recognize that. And the majority of volume, most volume happens at lower price points. And that's where the steepest drops in active listings are. They're down over 80%. So of course, overall volume has dropped. This is why it's important to recognize that we don't have one market. We have multiple markets, and we have to think about which market we're looking at and which clients we're thinking about when we communicate our market realities to them. Because the realities of the high end get lost when you put them within the averages of the whole market. So it's important to drill down like this. Because yeah, sales past 2,000 a foot have absolutely nothing to do with what's happening at sales volume below $500,000, right? Nothing. It's a separate reality. Next, all cash transactions. Look at this tri-county. So this is a very simple sort of divider using $1 million as a crude benchmark for both. We have Miami-Dade, Palm Beach County, and Broward counties. Again, looking at Miami-Dade, condos are heavy cash, below $1 million, 51% all cash, above $1,068,000. Single family less, 19% below $1 million, 45% above. And this pattern, like I said, the counties are all following the same pattern, but to varying degrees. We have Broward, 55% for condos under $1 million, 75% above. Similar pattern, Palm Beach is higher, 85% all cash, condos over $1 million. And same patterns holding for single family. The below $1 million, lower percentages all cash, above $1 million. We're getting at that 45, 68 benchmark. So same patterns. The higher up you go in price, the more it is all cash. And condos, for whatever reason, are more all cash than houses. Next, we're going to drill down using Miami-Dade. This is Q2 data from Miami-Dade County showing the distribution of all cash buyers across price points for single family and for condos. So again, as we're seeing here at the lower price points, interestingly, it's higher all cash below $500,000 than it is between 500 to 99, leading me to believe that perhaps that's actually investors buying less expensive houses to rent, or who knows, 23%. It dips a little bit between the $500,000 and $1 million, and then look at that, it just climbs. And this is that thesis again. The higher up you go in price, the more we're getting all cash buyers. Past 10 million, there are not many transactions, but they were all cash. And even past single family, past 5 million, we're at 65%. Condos even more shocking. Condos at 5 million, we're almost 80%, 79%. And just at 1 million, in that 1 and 2.5 range, are 66 and 69. So it's a heavy cash market for condos, kind of across all price points. Even below $500,000, 51%. Next, Broward, same pattern holds. Same pattern holds. Interesting that same pattern for single family, that below $500,000 is slightly higher all cash than $500,000 to $1 million. Perhaps again, also those are investors buying properties to rent because you tend to get higher yields on less expensive properties. And just like with Miami-Dade, that percentage just grows. 40%, 65, 71, then 100% past 10 million. And Broward again for counties, same pattern, but actually higher. At 2.5, we're already to 81% all cash with Broward County for the condo market. Next, Palm Beach, same patterns. 35, well, actually they're even there for $500,000 and $500,000 to $1 million for single family. But overall, this is what I'm emphasizing. Same patterns, Tri-County. The higher up you go in price, the higher we're all cash. And once you pass the luxury segment, all these markets are overwhelmingly all cash, especially the condo market. Okay, this is yes, calendar years showing gross dollars spent in South Florida. This is sorry, just Miami-Dade, but again, the same pattern holds. We've seen a doubling essentially of dollars spent versus pre-COVID, and this shows the skewing of a sales volume spike at the very high end, which can quickly drive up these numbers. So this does show us the flow of cash, just money, sheer dollar volume into South Florida. All right, so this is where it gets fun. Where is this money coming from? That's the multi-billion-dollar question. I'd like to point out that the spike that we had during the immediately post-cataclysmic event, so immediately post-COVID, that spike, that was a domestic spike. International buyers, which have always been a major force in Miami, especially in our condo markets, they were home. They weren't zero, but their volume decreased. They came less. So international buying did not spike in the immediate aftermath of COVID. The spike that we have seen and that we still enjoy was one that was driven by domestic wealth migration. And that is something that is very much in its early stages, and that I think is a force that's going to play out in the next 5 to 10 years, because momentum builds and the world is now reshaping. We had a break in habits, and the world is reshaping around the internet and post-COVID realities. So all migration also is not equal. The state of Florida and the state of Texas are roughly tied for gross population, incoming gross population. Big distinction though, the state of Florida is the largest recipient of taxpayers filing over $200,000 a year. We have roughly 4 times as many than Texas. We had 20,000 come in, what was that, 2021 or 2020? Texas only had 5,000. And we know from further data that this pattern has held. Next, we have a clear pattern here. I love the juxtaposition of these charts. The chart to the right shows color-coded 2022 gain and losses in population, and we see that continuing from the immediate aftermath of COVID. We see the states that are bright green. We see Texas and Florida, and then we look in the left and we see top marginal state income taxes. And there's no coincidence that these are kind of mirror images of each other. So post-COVID, and these states also tended to be high lockdown blue states. I'm a registered independent, so I really don't care about their political affiliation. I'm just noticing the pattern. Blue states with heavy lockdowns, which tend to have high income taxes, are the ones that are now hemorrhaging population, and not just population, but high value population. And we have IRS data showing that in fact, there's a spike in the percentage of high value earners that are changing their state of residence. So there's a major shakeup happening in our country within people who have money and who can afford to move, which also makes sense when you think about life reshaping around the internet. People who earn more money tend to have jobs that are more reliant upon technology and less upon their physical presence, and are more mobile, and they have more money. So COVID broke their habits. Perhaps they didn't appreciate the lockdowns. Perhaps they realized that they don't need to go to the office every day. All these things came together, and a significant percentage of people who earn money have decided they're going to move. And the patterns couldn't be more clear than when you juxtapose these charts. So momentum cycles are very, very real. This is one thing that I keep talking about. We look at these charts, these snapshots. What happened in 2022? What happened in 2020? Well, these charts represent the movements of people. And these people take money with them. They take money, they take families, they take jobs, and they establish them in someplace else. When they come with them, others follow. So while we are receiving wealth and talent, our feeder jurisdictions are losing wealth and talent. And it is very, very important to remember that 1% of taxpayers account for over 40% of taxes levied in our feeder jurisdictions. And if they lose just 10% of those people, they would have decimated their tax base. And that's what's happening right now. And what happens is that politicians tend to double down on losing policies because they want to get reelected. They do things that make no sense. For example, Chicago, which already has extreme population loss as defined by the Census Bureau, has a new mayor who comes into office in the first week. He proposes new business taxes and wealth taxes. What is the logic behind that? They're already hemorrhaging population and actual taxpayers. Well, if you think about it, politicians only care about getting reelected. They're not aligned with the long-term prosperity of their jurisdictions, right? So they're just going to keep doing stuff to get themselves reelected, and they're going to keep pandering to the growing percentage of people who do not pay in. Thus, they're going to accelerate this negative feedback loop in their states. California has been floating retroactive exit taxes forever, reparations, all sorts of stuff. Meanwhile, they're literally hemorrhaging taxpayers. And why? Because the politicians only care about getting reelected. That's their end game. Once you see that, their actions start to make sense. So while they are going to keep feeding their negative momentum cycles as their budgets continue to have shortfalls, we are going to keep feeding our positive momentum cycles, and these realities will continue to diverge. And this is why I said empire cycles. Our country, our empire, is in a phase that is just defined by polarization of wealth gap, of belief systems, of all that stuff. And now people are also relocating geographically based upon their belief systems. So the whole country is polarizing like crazy. And again, we're lucky to be in South Florida, in my opinion. All right. So I was saying our positive momentum growing. I have a few examples of things recently in the news. This is data from March of 2023, saying that Florida had the highest increase in job openings. And in fact, 5 of the top 10 metros with the highest net inflows were located in the state of Florida. Next, Stripe, the payment processor, ranked Miami as having the fastest growing startup hub in the world. That we had 89% growth in startup activity between over a 5-year period, starting in 2016 and 2017, which was very, very significant. When I moved to Miami 10 years ago, there was no such thing as a startup scene. It didn't exist. And now we have companies in the news that are moving here all the time. We have startup hubs, accelerators, all this stuff here now. So this will again keep feeding itself. Next, this is a great one. I did a little bit on this last week. I think this is so fantastic. Miami has led the nation in new business applications. So there were 5 million new business applications filed in the country last year, which averages out to, was it 15.1 for every resident. Miami had 40.9 filed per 1,000 residents. Number 2 is Atlanta, far behind us with 31.3, and Orlando number 3 with 28.7. So if this is not an indicator of positive momentum, I don't know what is. I mean, this is fantastic. This shows us that we're getting people who are coming to Miami, not to retire, not to sit on the beach. That's been the big shift, not to park money from Latin America in condos. We're getting people moving to Miami because they want to pursue the American dream. They want to live and they want to create, and they're bringing their families here. This is what data like this tells me. Next. This was also in the news recently. This is fantastic. This was, I believe it was in the Journal or Bloomberg. I think it was in the Wall Street Journal. For the first time in US history, the 6 fastest growing southern states, of which Miami is one, now account for more of national GDP than the Washington, New York, Boston corridor. They're calling this a tilt in the economic center of gravity. I've been using the phrase shift in focus for 2-3 years. I think it's pretty much the same thing. We're saying different words to mean the same thing. There's a shift in focus, a shift in economic gravity, whatever you want to call it. And again, obviously this follows that map of job creation, of migration, of raw population and high value taxpayers. It's leaving high tax blue states that had high lockdowns, and it's shifting. And again, now the 6 fastest growing southern states account for more of national GDP than that Northeast corridor. I think that's extremely significant. So conclusion and future prediction, follow the money to Miami. I think it could not be more clear. People are moving again. They're coming here to pursue the American dream. As we absorb wealth and talent from our feeder jurisdictions, they will continue to have budget shortfalls. They will continue to double down on losing socialist positions, and we will continue to benefit. I do think the world is going to be more multipolar in this 21st century reality than it was before. And within that, I think that Miami and South Florida specifically, that we are emerging as an epicenter of this new world. We have all the ingredients in place, and our positive momentum will just keep coming. So remember, a change is inevitable. There is this fallacy in human nature to think the president is sacrosanct. Don't be that person. Recognize the world changes. Think how differently we lived 100 years ago versus how we live now, and expect even more change coming forth. It is on us to recognize where that flow of human ingenuity is going, because it always goes somewhere. And it tends to go towards the places of least resistance, places that are most conducive to the flow of creativity and ingenuity. That's where it goes. So recognize where that is. Put yourself there, put your money there, put your clients there, align yourself with it. And I think that Miami and South Florida are that place. So that's a wrap on the first webinar, half an hour even. And now we have time for questions. Anyone?
Everyone just come off mute, type in the chat your questions. Anna, I'm going to start with a question that I think you could help expand on a little bit, is the idea that Florida is that retirement state, and seeing that we saw new business applications. I know CNBC said that Florida was the 10th worst state to live and work in. What is that discrepancy? And like, why are so many people moving here and like creating businesses versus what they've done in the past?
Oh my goodness, I'm so glad you brought that up. So he posted this fantastic chart on his Twitter. I think it was yesterday, showing that list, right? That we were the worst. But what wasn't the list comprised of a high percentage of states that are red?
All of them were red, all top.
All of them were red. Okay, all of them were red. Yeah. So that to me, I think, as you said as well, is clearly a partisan jab. I think that they're sore that shift is happening, right? Because when money shifts, like we see now that our region contributes more to GDP. When money shifts, that is also indicates a shift in power, and an inevitable shift in power, and that's what's happening. And so these previously entrenched forces of influence, they don't want this to happen, obviously, and they're probably a little bit bitter about it, because worst places to live, that's their opinion. We're all entitled to our opinion, right? Did they have data to back that up? How do they quantify that? They could say, I don't like chocolate ice cream, it's gross. That's their opinion, right? There's no data. We do have data quantifying that people are coming. So how do you argue with success? Are those people stupid? You're calling them all wrong. They've all made mistakes. You're right because you made that list. That's basically what they're saying. They're saying that all the people who are moving here are stupid and made the wrong decision. All these people opening businesses, all the high net worth people coming here, they're wrong. I knew a stat was with the IRS. The median income of a resident from Manhattan, I think it was for 2021, who relocated from Manhattan to Palm Beach County was over $700,000 a year. Okay, so all those people are stupid, like they don't know. The reporter who put that list together knows better, I guess. I mean, I think it's just like they're a little bit sore about it, and they don't. They probably feel it's inevitable, and they're just trying to. They're jealous. You can't argue with success, right? If they quantified it in some way, I would say, but we're getting high value people. We're not getting dummies. We're getting people who are coming here to live and work. So. But I expect more of that. I expect more of that type of stuff to come out.
Me as well. Anyone else? Come on, come off mute, type in the chat. This is your opportunity to ask whatever you want.
Nope, nobody? I see you all there. Okay. Well, I thank you all for coming. This is a really exciting time in our market and in our city and in our region. We're going to do these webinars once a month. We're going to start with, this this is a story that's gonna write itself over the next 5 to 10 years. So we're always gonna have interesting things to talk about, new data coming in, corroborating what's happening. So we're always gonna highlight up on the macro topics, and then we're gonna dig deep into various segments of our markets in South Florida. So please let us know. We really appreciate your feedback. If there's anything that you would like covered, ask us questions that we can address. Also, I think that we have a promo code for everyone for this. Right, John?
We do. I will put it in the chat. The promo code's for 50% off on our site, our subscription service. That includes obviously the weekly insights that we send to your inbox every Tuesday, but it also includes another email of weekly insights that we send to your inbox every Thursday. It will also include monthly webinar calls like these today, where you can literally ask whatever you want about any topic. We try to keep it within real estate, but we also will release quarterly reports and a few other things throughout the year exclusively for members. So I will type in the promo code in the chat now. It is webinar 50, all caps, but use that. You get 50% off all subscription services on the site.
All right, and this first one will live on the site as an example, and then we will take it from there. And again, I appreciate you guys. Please send your feedback, any ideas.
Oh, Anna, we got one more question. How many more high-paying jobs do you expect in the next year or two?
Oh, I mean, gross number, that's a tough question. Our unemployment rate is doing great. I know I don't have a number. I can't give you a number, but I believe that it will only continue because the high value jobs like finance industry jobs and tech jobs, they're the most portable. So I expect that we will continue to receive them. We have guys like, Ken Griffin in the news, they're kind of the vanguard of all this. And when they do something, it makes it okay for others to follow. And again, those are very high paying jobs. And I expect more of those industries to they've all led by example. And they've all been very local about why they've moved here. And I think that's opened the door. So I think we're raw number, I don't know. But I think it's going to accelerate. I think we're going to get more than we've had. And I think that door has been opened and people are just going to come following now, especially because where they're coming from, those jurisdictions like Chicago, where Ken Griffin left, they're doubling down on wealth taxation in the wake of the exodus, which is mind-boggling. But again, politicians don't care. So that's what's happening. So I expect an acceleration.
Yeah, I can add to that as well. I think with the amount of luxury buildings that are getting built, especially in the Miami area, I think it's hard because there's a gentrification that's happening, right? And people are getting pushed out that don't have those high-paying jobs and can't afford to live in the area. And it's unfortunate people that live here for 20 years. But when guys like Ken Griffin and Citadel come down, they're setting the stage, right? They've done their research in Miami. They know exactly where this place is going to go over the next 5 years. At least they have a good idea. And yes, this recording will be sent out.
Yes, yeah, great points. We're building product to accommodate that migration as well.
Yep. Make sure to.
Yes, I agree. So that the dip rather in international happened post-COVID because they could not come. They quite literally could not come. So now we're seeing a resurgence of that. Actually, there's Miami International Airport. We have air traffic data for departures and arrivals, and our airport traffic has exceeded pre-COVID numbers. When we break it down with domestic and international, that new high is because domestic travel has far exceeded previous numbers. International travel is coming back, but is still below pre-COVID levels. It's coming back, which is a very interesting point. I think the spike was from domestic, but the international travel, we know from the airport data, is only now coming back. And so, yes, now that people are traveling again and coming out again, absolutely, they're going to come back to this market. So I think that's a very important point. This spike we saw was in the absence of the international buyer. So this new floor, this rising of the floor, this creation of new price points was set largely by a surge in domestic action. And now the international is going to come back on top of it.
What are your, Anna,